Thank you so much. I think we can start now. The chairman is here with us. Let me say good morning to all of us. You are very much welcome to this monetary macroeconomic policy session we have today. My name is Dr. Justin Amase. I am the managing director of Macrostrat Nigeria Limited, a premier policy and governance consultancy firm located at number 70 Usuma Street, Maitama, Abuja. Today, we are privileged to have with us very distinguished experts, the panelists, most especially the chairman and the moderator for today, Dr. Ayo Teriba. I want to welcome the chairman once again and welcome all the panelists. I welcome all the distinguished panelists. Ladies and gentlemen, today we will be taking a very close look at the monetary policy decision of the Monetary Policy Committee of the Central Bank that was done yesterday. Now, we are aware that inflationary pressures have continued to persist, and most of the sources are not just from within, but we have the global conflict in the Middle East contributing so much to the ongoing rise in the price of oil and other commodities, as well as the volatility of inflation, domestic inflation in Nigeria. Now, given this background and the fact that we expect to have an election very soon, and election spending will compound the situation together with the structural issues we have on ground, the central bank decided to uphold status quo by leaving the MPR at 26.5%, and all the other rates and ratios as they were, including the corridor. Now, we all know that at 26.5%, that is pretty high, especially given the challenges that are associated with high anchor policy rate. Most especially
Dr. Amande, let your panel make the judgment whether it is high or it is low, please.
Thank you, Chairman.
Kindly do not bias.
I will give a background.
Do not bias our minds. Thank you. No judgment.
Thank you so much.
You. Thank you.
Thank you, Chairman. So, ladies and gentlemen, permit me to hand over the virtual floor to our distinguished chairman, Dr. Ayo Teriba. Now, just in case you don't know Dr. Teriba, his name has always been a recurring decimal in the policy journey of Nigeria. To cut it short so that he doesn't interrupt me again, Dr. Teriba is currently the Managing Director of Economic Associate, one of the most prominent economic consult and policy consulting firms. He's also the advisor to the current Minister of Finance. So join me in welcoming Dr. Ayo Teriba. Chairman, you have the floor. Thank you.
Well, thank you very much, Dr. Justin Amande. I commend you for putting this initiative together. It's a very, very unique opportunity for experts to have an opportunity the day after the Monetary Policy Committee decision to take on the issues. And it would be nice to just leave the floor open for the panelists to give us their opinion. I would moderate, and I'll chip in, not at the beginning, maybe at the end, but as necessary, maybe in the course of the presentations. But please, before you ask me to take the floor, it would be nice if you could kindly introduce our panelists and also set the ground rules about the duration, for each intervention. It's those ground rules, so if somebody can introduce our distinguished panelists and tell us the agenda, then it will be my role, as moderator to enforce the agenda. So, but I would still love, for you and your team to make the introductions and to give us the agenda. Thank you very much.
Thank you so much, Mr. Chairman. I would rather prefer to differ slightly. I would prefer the panelists to introduce themselves with their videos on individually so that the audience can see them clearly. After that, I can run through the agenda. I hope, Chairman, that's
Thank you. Thank
okay
you.
by you.
That's fine. That's fine. That's very fine.
Okay. Okay. Let's start with ladies so that they will complain of marginalization. Dr. Faith Yoha, you can introduce yourself and all the others will just follow. I don't need to be calling them one by one. Thank you.
Okay. Thank you very much. Good morning, everyone. It's nice to be here. My name is Faith Yoha. I'm a Deputy Head of Research at the Nigerian Economic Summit Group. Thank you.
Okay.
You're welcome, Dr. Faith.
Good morning, sirs, Chair and distinguished panelists. My name is Evans Osabohian. I'm Professor of Economics in Cambridge University and also the founding chair of DIADEC, the PECOS institutions, and the Women's Research Center in Otago State. Thank you so much.
Dr. Evans, you're welcome. You said which university?
Covenant University, sir.
Covenant, okay, thanks. Thanks. Welcome.
Okay, maybe I can jump in. Good morning, everyone. Quite happy to be here this morning. My name is Adedeji Adeniro, Director of Research at the Center for Study of Economics of Africa. Thank you, and over.
Dr. Adedeji Adeniro, you're welcome.
Thank you so much.
The Center for the Studies of Economics in Africa is in Abuja.
Economics of Africa. Yes, sir.
It's in Abuja.
Yes.
Dr. Ngozi, is that Dr. Ngozi Okojo in Wellers initiative?
Yes, sir. I think
okay.
That's correct.
You're welcome. You're welcome, Dr. Adedeji.
Okay, next panelist, please. Can you introduce yourself? I saw Professor Comfort Amiri on the call here. Prof, can you introduce yourself, please?
You're muted, ma'am. We can't hear you. You're muted, Professor Comfort.
I think it's a network. No, she's not muted, it's a network. Sorry.
Okay, when she's available, we'll give her the floor to introduce herself. So, any more panelists, Dr. Amanzi?
Yes, Dr. Chairman, sir. My name is Dr. Ruslanuddin Mohammed. I run a consulting firm called TriSpeed Consulting today. The former
you have Dr. Evans and we have Dr. Adedeji,
Chief Economist of Bank of Industry.
The name, please. Dr. Islamuddin.
How are you, Doctor?
Very well.
Thank you, sir.
You're welcome. God bless
Thank you. Thank you. Thank you. Okay.
Good morning.
Good morning, Prof.
That's Professor
Go ahead,
Comfort.
Prof.
I'm Comfort Amiri, sir, a professor of economics from Crawford University and the chairperson of Ogun State chapter.
Somewhere around Agbara.
Thank you, sir. Thank you for having me.
You're welcome, Professor Comfort. Okay, please. It's my pleasure to welcome the panelists. So we look forward to very, very fruitful, interaction. Before we open the panel session, it will still be to set the agenda. So we all know the ground rules, because where there is no rule, there is no sin. So once they set the rules, we will be obliged to abide by the rules so we can get the best out of the session. Dr. Amanzi, over to you.
Thank you very much, distinguished chair. Thank you, everybody. We're going to have a total of 2 hours for this session, and we have started utilizing part of it. Now, this is the program. We have we have already taken the chairman's keynote briefing. Now, we have 6 minutes for each panelist. Thereafter, there will be a panel discussion. Finally, there will be questions and answers. We advise all participants to channel their questions, to write their question on the webinar chat link, and then forward them. All the questions will be harvested and forwarded to the chairman. Now, the first session, we start with Dr. Faith Iyoha. She will be looking at the trajectory and the direction and implication of on local credit market and the borrowing cost of the monetary policy decision. The second panelist will be Professor Evans Osaboyan, who will be looking at the macroeconomic outlook especially with trends in headline inflation and interest rate. Then the third session will feature Dr. Rislanuddin Muhammad, who will be looking at banking liquidity management, the impact of the tight CRR, cash reserve ratio, on credit growth and on sector investment. Then the fourth session will be taken by Dr. Adedeji Adeniran. He'll be looking at the liquidity ratio and the financial stability implication during the immediate post-recapitalization era, which the banks are going through now. Now, the fifth session will be taken by Professor Nikita Oba. He'll be looking at the foreign exchange stability, capital inflows, and the asymmetric corridor impact of the decision. The final session will be taken by Professor Comfort Amiri, who will be looking at the role of fiscal coordination in aligning monetary constraints with government fiscal policy and structural economic bottleneck. Now, after that round, the moderator will take over and have a panel discussion with all the 6 panelists. Now, the digital questions and answers, like I said, should be written and forwarded to the chat box there. There is also going to be a final closing and call to action, where the chairman, stroke moderator, will summarize key policy takeaways and final wrap-up thoughts. And I will deliver the closing remark. Then for the technical execution of the webinar, there will be a strict enforcement of timekeeping. Then the panelists are expected to deliver spoken analysis using data sheets instead of presenting screens. Then there will be the aggregation of the questions and answers. I think this is a summary, Mr. Chairman, and I believe you can take back your floor from me. Thank you, and thanks, everyone.
Thank you very much. Am I audible?
Yes, you are, Prof.
Thank you so very much. Let me say that the questions will be read by one of the members of Dr. Amande's team. You read it to our hearing, and whichever contributor it is directed to will take it. And it's my pleasure now to declare this panel session open. And Dr. Amanze has announced the sequence of the speeches. He did not announce any time allotment. It remains for us to manage it, and let's do it in such a way that each panelist can have 3 chances of speaking. So I would want the panelists to make opening statements of about 5 minutes. So we go through all the panelists. Know that this is the opening statement. So give us your best 3 points or your best 4 points in summary. And after that, we can probe and we can see if there are questions directed at us so that you can have a second round to address the issues either raised by me from the chair or raised by the very distinguished members of our audience. And then after you clarify, we can then each have a third bite at the apple in the form of closing thoughts. So 3 opportunities. You do not need to say everything in this opening salvo, but just give us the broad direction of your thoughts. No lectures, pitch it more like keynote thoughts so that we can get the most from each contributor and the audience can have an opportunity to engage and they can have an opportunity, if you like, to moderate. So, Dr. Faith, you are the first, panelist. You have the floor for 5 minutes. Thank you very much.
Thank you very much, Prof. I'll keep my thoughts very short. So, first of all, I want to say a very good morning to everyone. Good morning to the moderator, our Prof, fellow panelists, ladies and gentlemen on the call. First point is that the MPC decision to hold up parameters, it's a reflection of CBN assessment of what the economy is. And it also shows some confidence around the current macroeconomic trajectory. It is a careful balancing, I think, between supporting economic growth and safeguarding macroeconomic stability. At the core of it, I think there are 3 things that stands out: price stability, exchange rate stability, and policy credibility, especially given the fact that investors' confidence have remained very significant over time. The PMI is doing well. Inflation trajectory has relatively been stable. So given this development, however, I think that these gains that we have seen around inflation, growth, exchange rate, policy credibility, investors' confidence, they are still fragile, especially within the context of uncertainty around the globe and also the electioneering process that is just about to start. Inflation remains elevated, and it's important to note that the major drivers of inflation is not largely monetary phenomenon, it is structural in nature. And so to address inflation or to tackle price stability, from that perspective, it is important to address structural constraints that are driving inflation. So at this point, I think my closing thought is to state that regardless of the CBN or Monetary Policy Committee decision, one important message for me that is really clear is that monetary policy alone cannot sustainably deliver inflation, reduced inflation, and cannot on its own achieve economic transformation. I think I'll close there. Thank you.
Dr. Faith, thank you very much, for the clarity of your thoughts and for the brevity. In a nutshell, there's tranquility at home, but the main source of risk, you have underlined, is the uncertainty coming from the escalation of the hostilities in the Middle East. And the minor source of concern is also we are in election season. I would want to limit my comments to this so that we can hear from the other panelists. So we just proceed to the next panelist, which I believe, is it Dr. Evans?
Yes, sir. Good morning, sir, again.
Professor Evans.
Yes,
okay,
sir.
please take the floor.
Yeah, thank you so much, Chair and the organizer, my dear panelists, and everyone on the call. I'll just take it from where my sister Faith stopped. There are 2 points I was asked to focus on: the macroeconomic outlooks and inflation trend. I also look at that with the interest rate. Just the first point to mention that CBN, in their wisdom, left some of those parameters in status quo, which some have called kind of a cautious holding, which is quite okay. But there is one key factor I want to mention, is the MPR at 26.5%. And another point again on that parameter is the standing facility corridor of plus 50 and slash minus 450 as basis points, which means the lending rate will be at 27%, expected for deposit money banks, and then the lending rate at 27%, and then the deposit will be at around 22%. So that also called issue of because the economy does not, like she has mentioned, does not thrive on one aspect alone. Somebody has said in one of the programs I had within a week at the House Committee on Finance around revenue, the domestic resource mobilization, is to look at that. But the summary that we cannot clap with one hand. The economy is involves not just monetary sector, but also what happens with the physical sector, physical policy. So there's such a need for a clear-cut interface between the two policies. So that's one point I want to mention. The next point again is the issue of inflation. Okay, we have also seen that in the last 2 months, between May and June, inflation dropped a little bit. That's the headline inflation. So one maybe headline inflation is the inflation that is the summary of all price changes. Of course, that makes up with the core inflation and then the food inflation. From the reports we've seen recently is that food inflation is actually rising, which is what is driving the headline inflation. And that means that we also seen that the inflation in Nigeria in context, just like Faith has mentioned, is not essentially demand side inflation. In other words, it's not too much money chasing two figures. So in this case, there's in terms of real sector, there's little that the monetary policy can achieve in driving inflation, which means the other side of it, which is the supply side of it, is very important. From she has mentioned the issue of the external sector, the exchange sector, but much more so. Another point to add to is the issue of insecurity we have witnessed in recent time. That these are points that affect particularly food inflation. How does that mean? The issue of clashes in farms, so that also affects food production, and much more so the supply chain. So all of that we have impact on food inflation, which is what we're seeing the inflation trends. So in summary, for this first point is that the cautious move to hold those parameters are quite important, but much more so the needs to also look at the lending aspect that will trigger risk center performance is important, and much more so to also ensure that we tackle inflation not just from the monetary angle per se, but a close handshake between the monetary policy and fiscal policy, because our inflation in Nigeria is not essentially supply side issue, but much more so of demand. Sorry, not demand side issue, much more of a supply side issue. So I will close that with this person. Thank you so much, Mr. Chair.
Okay, well, thank you, President Evans, for providing more details on the interest rates and inflation. Again, I would want us to hear out all the panelists before I weigh in. So I will simply proceed to the third panelist, which I believe is Dr. Islanuddin. Am I right, Dr. Amanzi?
Yes, you are right. You are right, Chairman.
Okay, so please,
Okay.
Dr. Islanuddin.
Okay, thank you
5
very
minutes.
much. Thank you very much.
Opening thoughts.
Thank you very much, Chairman. I think minus the analyst, that is those that are informed in finance, in economics, and so on. It is easy to predict the outcome of MPC. I may be wrong, but this is my own position. It's very easy because over the last 3 years or so, clearly the central bank, monetary policy committee have focused on their core mandate. That is financial system stability, issues around price stability, challenges with inflation, exchange rate, interest rate, and so on. So to that extent, given the macroeconomic fundamental, I don't need to repeat what my colleagues have earlier on said. It is easy to predict that this trajectory is what we expect, some kind of a halt, because we are in kind of a disinflationary situation. Suddenly inflation went up, but I think it's manageable. But it is too tight to expect any reduction, given the thinking of the Monetary Policy Committee over the last 3 years. However, my own challenge is, to what extent has this policy over the last 3 years supported Nigerian economy? The answer is, to me, there has been macroeconomic stability quite okay. Exchange rate is fine. Interest rates has moderated. Inflation is easing up. We're in a disinflationary situation, minus the minor bump that we have had in the last 2 months or thereabout. Now, when you look at the impact beyond monetary policy, and that is where my own point comes in. Monetary policy alone cannot solve Nigeria's problem. We are analyzing outcome monetary policy committee and its impact. Now, if you look at, for example, the decision on MPR at 26.5%, naturally you expect borrowings above 26.5%. What are you going to do as an industrialist? So what I'm saying is that over time, the outcomes of monetary policy committee becomes disinteresting to a man, for example, to an SME that expect interest at 26%. Who's going to borrow? In any case, which bank is even lending? Why are they not lending? Because there are advantages also in successive monetary policy decisions. For example, issues around investment in fixed income market with MPR well close to 30%, 26.5%. It's easier, risk-free for banks to invest in fixed income market. They don't need to get into any hustles of recovery. They don't need to get into hustles of having bad loans and so on. So they lend and they make money. But what is the impact on the industry? What is the impact on businesses? What is the impact on job creation? Has the policy make any impact? The answer is no. And of course, we are not blaming central bank because they are doing their job, and their responsibility based on their core mandate is monetary policy. And in order not to jump into conclusion, maybe at the next round, but I can just mention that a monetary policy alone cannot transform Nigerian economy. there is underlying imperative of having an absolute synchronization of policy between monetary, fiscal, and trade policies. Without that, yes, we can have broader macroeconomic stability, but we will have lack of jobs, we'll have industry folding up, we'll have poverty accentuation, and we may also have, by extension, insecurity challenges. So macroeconomic data can look so rosy, but deep down, we can see challenges. We can see the economy. We can see ordinary Nigerians saying, what impact has that got to do with me? What am I benefiting? They say inflation is coming down. No, I don't believe it, because I can see food inflation going up. I can see the prices of goods and services that I go to the market to buy going up. So are we to blame central bank? The answer is no. To me, the central bank have done their job. What is important is for the fiscal authority to think out of the box and work with the central bank to see the kind of intervention, direct intervention they can make to ease up, to be able to support small businesses, to support SMEs, to support job creation, and so on. So without that, we can have in absolute terms, the data fine, but clearly we may have challenge with the impact on an individual. And there is always this saying that at the end of the day, whatever policy the government articulates, however rosy the data comes into being, the net impact is what is most important to Nigerians. So let me hold on for now, because I'm just being cautioned that my time is off, and I'm sorry, I'm the first person to be given that yellow and red card. Thank you, Chairman.
Okay, Dr. Ismail, thank you. You moved the conversation towards impact on the economy. There, of course, it's been said by previous contributor, the central bank focuses on its own mandate, which is about financial stability, broadly about financial stability, but very narrowly about price stability. And you are broadening the conversation to price stability at what cost? Must we sacrifice job creation on the altar of price stability? The American Federal Reserve Bank has a dual mandate. They don't have a single mandate. And they have a dual mandate of price stability and full employment. The Nigerian CBN Act does not give them an employment mandate. In the UK, they have a price stability mandate, and they have a mandate to support the growth efforts of the government. The CBN Act is similar. So they should maintain price stability and support, the developmental objectives of the government. So nice twist to it. You did that at the cost of exceeding your time allotment by about 2 or 3 minutes. We'll see if we'll debit your second and third intervention. We will see. Let's see as we go. But that twist is notable. I won't say more. It's okay. It's welcome. I won't say more on that, so I don't take the wind out of the sail of the other panelists. Let's hear out the panelists, and I can provide my view alongside the views from our audience. So let's go on. Is it now the turn of Dr. Adedeji? I think Professor Comfort is the final contributor. Dr. Amanzi.
It is Dr. Adedeji's turn, Mr. Chairman.
Dr. Adedeji, the floor is yours. 5 minutes.
Thank you so much. Thanks so much. Yeah, and I think colleagues have really spoken very well on the implication of the MPC decision yesterday, and why the decision is maybe the kind of the best approach, but I think I want to start from where Dr. Risladin stopped in terms of his comment around what this or even not mean for the larger economy. And I think the MPC actually highlighted one aspect of that I think I want to really come into, which is the fiscal monetary policy coordination. One could also understand the kind of risk approach that the World Bank, the central bank is taking, given that we are coming from a regime whereby the central bank really concentrated on growth policies, having to then really exceeded its mandate, going into borrowing and some sort of losing its focus, which has detrimental effects on both its monetary policy control. So again, we are seeing a regime that really tried to focus on its mandate around price stability, which speaks to inflation and also exchange rate. So I think at that level, one could understand that decision to really see that in terms of there would be two more kind of MPC meetings this year in September and November before we have our election. And you remember that there will also be US election that might change a lot of things after November election. And so you look at this both external factor and also our own internal factor. We see that, you could see that price stability factor is quite important. And for that reason, that decision is quite understandable. But more importantly, for our economy, how do we ensure that that monetary policy decision and also the fiscal policy decision, it's really well integrated? Like I said in the past, policy coordination has been a challenge, whereby fiscal policy tends to really become too expansionary and at the risk of the decision that monetary policy will take. In more recent time, I think we see more coordination. I think in that respect, I want to say that one of what we have seen in the most recent MPC meeting is really to see fiscal policy as kind of leading the direction and monetary policy trying to maybe claim some of the problems that might be or some of the need extra intervention that might be needed in that area. And that's why I think when we talk about growth impact, we need that monetary policy coordination. And very interesting, the committee also mentioned Executive Order number 9. And I think for those that don't know that executive order, it's about remittance from NNPC. Again, that is saying that there will be more kind of huge boost in government revenue at the state, federal, and local government level. And that will be more injection of liquidity into the system. And that really speaks to where some of the reasons why, if, for instance, the liquidity was restricted to the amount it was, because there is expected going to be upsurge in liquidity to the government. And if you allow these, that could mean the policy could be working hand in hand when you are restricting the MPR rates, but at the same time, you are allowing the liquidity bandwidth to change. That would really could really jeopardize some of the policies. Like we have said, banks that are expected to lend to the government, they could really concentrate on just riskless government security as part of their agenda. So what I want to really see as the way forward is we need to strengthen more on that corridor of fiscal monetary policy, because we are seeing price stability and we can't jeopardize that. What extra layer do we need to really see? And I think there is a lot of, I think we could discuss in our discussion around what do we need at the fiscal policy and what do we need at the monetary level. I think at the monetary level, we need to really get that stability in terms of exchange rate and inflation, right? I think that would be a source of economic growth for us. But more importantly, we need to really re-engineer and really our manufacturing sector. And to do that, I think there is need for fiscal policy also to come in, especially in the sectoral policy angles, whereby we could really see what can we do better in terms of input, what can we do better in terms of policy alignment, what can we do in terms of also trade policies. I think those are that coordination we need to really be thinking around in terms of restarting the economy such that real sector benefit from all of this stability we are talking about. Thanks so much. Let me end it there.
Thank you very much. Also, for the brevity of your intervention, you've spoken about the harmonization of the different components of macroeconomic policies. There's monetary policy, yes, but there's also fiscal policy. But the third leg is there is a forex policy. And the fourth leg is that there's sectoral policy. And unless these are coordinated, one can spill over into the other. They co-evolve, and you cannot have effectiveness of monetary policy in the absence of effective fiscal, forex, and sectoral policy. So there is a need for harmonization of the co-evolution across policies. Again, I'll just reserve my detailed elaboration until we've had our remaining two. We have two left, or we have one left. Is it only Prof that is left? Professor Comfort. Okay, so before I call on Professor Comfort, I'd like to encourage our audience, a very distinguished audience, to please write their comments and questions so that once we hear from Professor Comfort, be clear about who you are directing your question to. You can read out a few of the questions. So somebody in Dr. Mansi's team should be helping us to group the questions. So you can read it out before I then call upon the panelists for their second bites at the cherry. And yeah, it's now for me to call on Professor Comfort to please take a 5 minutes opening statement. Professor Comfort, please.
Thank you, sir. Good morning, all. This segment is to look at aligning Nigeria's monetary, fiscal, and structural policies. And the theme that I think we should focus on as at now is one direction, one goal, ensuring that all economic policies work together, not against itself, to stabilize inflation, support growth, and strengthen the Naira. The current decision of the MPC, well, is good, but the interest rate is still high. But the goal to control inflation and stabilize the Naira is quite agreeable. But when we look at the fiscal policy side, coming to government side of it, we are still looking at it that is still expansionary. We still have high public spending, persistent deficits, and continuous borrowing. And all this, we are to ensure that these things work together and should not work against each other. Aligning monetary and fiscal policy will require fiscal discipline, which is very critical. We should be able to cut non-productive spending, and we should improve revenue mobilization. I'm not talking of just increasing taxes, but the efficiency, our utilization of the tax revenue. The outcome, if government can lessen borrowing, I want to say that inflation will begin to be reduced without choking private sector credits. As much as possible, I'm looking at if there's a way the government could plan smarter government borrowing, and we can also target fiscal stimulus. When we are looking at fiscal stimulus, I'm looking at it in the fact that our agriculture power, transport, manufacturing clusters should be worked upon. Because if we tackle cost push inflation, which monetary policy cannot fix, it will move the nation forward. Take, for instance, the power sector reform. Majority of our businesses, they still heavily rely on expensive diesel generators. And we know that this will lower, we will be able to, it will always increase production costs. But if there is anything the government could do in that area, it will lower production costs, it will lower inflation, and there will be room even for rate costs. Moving to logistics and transport. When we look at our road network, it is still poor, and because of that, moving goods from one place to the other is very expensive. I want to say in effect that if the rail development, port efficiency, road infrastructure are looked at, it will still help to reduce logistic costs and goods become cheaper. Then inflation will be lower. Agriculture, for instance, and food supply. Food inflation is the largest driver of inflation. If you cannot do anything that will still stabilize food prices, we are still waiting time. NPR alone will not do it. As much as possible, if we look at institutional coordination as well, of the opinion that is the missing link. We should unify the macroeconomic strategy. The Central Bank of Nigeria, Ministry of Finance, Budget Office, we should work together. If by through data sharing and other tools, if they work together, we'll be moving Nigeria forward. During the short time, medium term, or long term, there will be job creation and other. What I am proposing, or what I would rather suggest, is that monetary policy control demand, fiscal policy control spending and investment, structural reform will fix the supply side constraint. Therefore, with demand control, with smart spending, with supply improvement, there will be economic stability. The takeaway here is that the solution is not just lowering the interest rate or keeping it fixed, but the real solution is strong policy alignment across all fronts. Thank you for listening, sir. Thank you, sir.
Thank you, Prof. Mr. Chairman, we are waiting for you, sir. Thank you, Prof, for the great job.
Thank you very much, Prof. Thank you, Prof, for broadening the conversation about policy harmonization and impact. Dr. Amanzi, check if we have questions. While we wait for you to collate the questions, I can chip in. I can chip in at this stage. That starting from about monetary, I want to chip in some of my own views before you take the course. All right? Dr. Amanzi.
Yes, I'm with you, Chairman.
Dr. Amanzi,
I have designated my colleague, Dr. Samson Simon, to bring out those questions. But I had thought that you would do the panel discussion first, or they will be tied to the questions and answers. If that's the way you want to do it, then my colleague will come up with a question, so we can join that together, sir. Dr. Simon.
Dr. Simon. But I want to some of the issues and express a couple of sentiments. Bank rate 26.2%. Market rates, talking about government treasury bills, and it's a bit more significant. The market rates are a bit more significant than the central bank rate. A central bank rate is disconnected reality. Some people give misleading but they are leaving at 50 basis points to attract foreign investment. There's no foreign investment that will 26.5 in Nigeria's economy today, because that 26.5 plus 50 basis points is not the central bank's deposit rate. Only the rate as with banks that are short of liquidity and not raise and of going to the central bank liquidity we have for the before the banks can go and discount their treasury holdings at between 15 and 20%. They can go and discount their FGM bond holdings. And the central bank plays at that window operations at the 15% range. So the factor monetary policy rate is the rate at which the central bank discuss in the government big record. So the monetary policy is just the jury rate. Nobody, no sense person. You got good bank. Go to deposit their money in the CBN special deposit facility. They don't even, the rates at which they deposit money is Dr. Manzi, can you hear me now? Am I muted?
Chairman, I can hear you now.
Okay, sorry, I was locked out
last time.
I was locked out. So please,
okay.
The CBN MPR is the jury. What happens at the discount window is de facto, and the CBN does OMO at that window. So I don't think we should worry ourselves. If the central bank, knows what they are doing, they should never set a monetary policy rate that is anything more than 25 basis points above the rate at which they discount. They should be reminded that the historical monetary policy rate in Nigeria was a minimum rediscount rate. So this window that only banks can access, and then you fix on reasonably high rates. When banks still has access to government treasury rate to meet whatever liquidity requirements they have. That's my first comment. My second is that more than the damage that a high MPR is doing, but it's not effective, because as long as banks and any other person that is holding treasury can go and get liquidity at the rate is like between 15 and 18%, the MPR is in effect. And if the central bank knows what is good for them, they should let it merge with market rate, at which they also do OMO. They don't do OMO at. So no foreign investor gets more than 15 to 20%. So foreign investors deal at the market rate. The second one is that the most damaging policy that the central bank is sitting on is the CRR. Most banks been forced to put 45% of their deposits. And in the case of non-TSR, non-TSA deposits, 75% at zero interest rate in the bank. When they could, Nigerian government is all over the world looking for bank money to borrow, but Nigerian banks have 28 trillion in CRR deposits, which they can't lend. And central bank is not paying them a dime more. So these are conversations that how soon will you ease CRR? How soon will you make MPR reflect market realities? I do think that these are vital comments because the central bank is living in a world of its own. Central bank, and then Professor Prof, the point that fiscal policy is expansionary was under Buhari, who borrowed more than 20 trillion in ways and means. He put a stop to it. He securitized the ways and means, but that money is sitting in central bank balance sheet. Now 28 trillion. They should offload it from the central bank balance sheet and put it in the market. So FGN security is forced upon the central bank as ways and means securities. And the central bank forces CRR on the bank. So 28 trillion being held of central bank securities, 28 trillion of bank money being sat upon by the CBN. Nigeria needs, the 28 trillion CRR money for developmental purposes. Federal government cannot implement capital budget. Any spending they've been doing under the Tinubu regime has been recurrent and debt service. 100% of the 2025 capital budget has not been implemented. You had the Senate yesterday saying that 30%, they give a deadline of 31st March. It's been extended to September. 70%, they have not started. So we don't have an expansionary fiscal policy. I think Nigeria has to tell itself the truth that unless you allow Nigerian banks to use that 28 trillion in CRR balances to fund capital projects, not just for federal government, but capital projects for state government and perhaps capital projects for private sector, which if it's used to fund capital projects, is not likely to be inflationary. But for the CBN to just put it there, zero interest rate, in a country where you have more than 100 million people living in poverty, we have to wake the central bank up, please connect to the real world. Use that, let the banks use that 28 trillion to lift Nigerians out of poverty. Those would be, I would like to pause there and then listen to the question and then see. There is no threat of election spending. In a country where the stock market has grown by about 50% in 6 months, if any politician gives anybody money now, they're going to put that money in the stock market. And any politician that knows what is good, he's going to put his money in the stock market. He's going to ignore the stock market that might yield 100% this year and go and be fooling around. So there's no threat to inflation. And what Tinubu regime has achieved more than anything else is they've unlocked liquidity. The foreign reserves is liquid, and the stock market is liquid, and it's lifting all boats. It's fueling growth. The central bank has no business pinching pennies. You've mopped up how much since the year began, but the stock market has unlocked 50 trillion. You can't mop that up. But nobody is going to be, letting the money they have chase inflation when the Nigerian stock market has been acknowledged as the one with the fastest return in the world, highest return ahead of South Korea. So people will put their money in the stock market. Thank you. I want to punctuate it there and allow questions to be listened to and let our panelists take a second bite at the cherry. And please, Dr. Amanzi, let us know how much time we have left. Thank you.
Sir, thank you so much, Chairman. Thank you so much for your very thorough analysis. We have one of our panelists on the platform now, Professor Likita Ogba. I don't know whether, Chairman, you will give him a little time to speak because we have not yet gone into the next session. Chairman, sir, are you there?
Professor what, please?
Professor Likita Ogba, he is one of the panelists. He couldn't join very early, but he has joined now. Is it possible for him to
Did he hear the other panelists? Did he hear the other panelists?
Yeah,
Dr. Amazi.
Well, I was coming in and out, so the network has been on and off, so it has not been consistent, actually.
Okay, did you hear the contributions of the other panelists? Prof.
The first two, no, but the third one, yes.
Oh, there has been 5 panelists.
Say that again.
There have been 5 panelists. Did you hear only
he
one?
He is the 6th.
I know.
I had only one.
Okay. Therefore,
he is the 5th
Ogba,
panelist, Chairman.
I know.
He is number 5,
know.
Chairman, sir.
I know. He has answered my question. Out of 5 panelists, he had only one. Therefore, I want him to just introduce himself. Then we take the questions. And I will let him take the floor. When we have had the questions, let's just hear the questions, please. So, right, Professor Ogba, why you settle down? Why we settle down? Let's listen to the questions.
Okay.
So it can enrich the thoughts that you want to share with us. Thank you.
All right.
All right. Thank you, Mr. Chairman. Thank you, Chief Executive of Macrostrat. Good afternoon, panelists, ladies and gentlemen. My name is Dr. Samson Simon. I'm a research fellow at Macrostrat, and I'm going to read the questions one at a time, if I have the permission of Mr. Chairman. The first question goes like this.
Dr. Samson.
Yes.
Dr. Samson, thank you so much. Before you read the questions, tell us how many there are.
All right, we have been curating them. So far, we have 9 questions.
We have 9 questions.
Yes, sir.
Okay, let's listen to the 9 questions. So go through the 9 questions without stopping, but tell us who the questions are directed to.
All right, sir. The first question is from Mr. Adefolarin Lamilekon, directed at Ms. Dr. Adeniran. Dr. Adeniran talked about misalignment on fiscal and monetary policies. How can this be resolved? That's the question.
Thank
the second
you.
question, all right. The second question is from Mr. Bello Emmanuel Oleni Pekun, directed at Dr. Faith Ihoha. This is the question. For your insightful presentation, you mentioned that monetary policy is not sustainable in controlling inflation. Will it be more accurate to say monetary policy alone is insufficient rather than unsustainable? Given the success of inflation targeting regimes in several economies, what empirical evidence supports your position, and what alternative policy mix will you recommend for achieving sustainable price stability? I'm going to the third question now.
Okay, Dr. Faith, I want to join you in dealing with this question about whether monetary policy is effective in tackling inflation, if you don't mind. Please Dr. Samson.
That's fine.
No, yeah. Just note that when we get to it, you and I will do it. Dr. Faith, please go on. Dr. Samson, please go on.
All right, sir. The third question is from Ms. Chinenye Uzodima, and the question is like this. It's not directed, it's not clearly specified to whom the question is directed at. To what extent do you think Nigeria's current inflation is driven by monetary factors versus structural issues, such as food supply, logistics, and energy costs? So it's all right. He stated that the speaker that talked about supply chain, so not specific person. the person that talked about
Any,
supply chain.
any of the panelists who wants to comment on it can comment on it, but we can take it along with the one that me and Dr. Faith want to deal with. Next question, please.
All right. Question number 4, directed at Dr. Adeniran. All right, it's the same question. I read it before. Number 5, directed at Dr. Mohammed. Dr. Mohammed was concerned about interest rate that will be flexible to accommodate MSMEs in credit access. What ways can CBN ensure that this, even as individual banks make adjustment on interest that suit their credit facilitation? The next question.
Dr. Isnaluddin, I'll also join you in dealing with that issue of credit access to MSMEs.
Okay.
Thank you. Thank you.
All right. The next question. Given that food inflation remains the largest contributor to headline inflation and is largely driven by supply-side factors, how effective can maintaining a tight monetary policy be in bringing food prices down? What complementary fiscal or structural measures do you believe are most urgent? It's directed at Professor Amire.
Okay, that's Professor Comfort.
Yes.
Okay, Prof. So, you have a pattern in me for that question.
Go on. All right. Question number 6. All right, sir. Directed at Professor Comfort too. Share insight on policy harmonization. What is the challenge to policy harmonization in Nigeria? Then the 7th question, directed at Dr. Faith Iyoha. Dr. Faith was spot on why monetary policy not enough to curtail inflation. What recommendation will you give to the authority, as it's empirical from the CBN perspective, that it must deploy tightening rate to fight inflation in Nigeria? Question number 8 now. This is for Dr. Ayo Tariba, the chair, sir. The CBN said the recent moderation of the food inflation at 15.91. I think this is not really correct. It's not food inflation that's 15.91.
That's headline inflation. That's headline inflation, yeah.
But that's what the question says. So it's one of the key considerations, as well as the ongoing Middle East crisis, informing retaining 26.5%. Kindly share your thoughts on this. I don't know if the question is clear, sir. It's directed at the chairman.
It's clear enough. It's clear enough.
All right. So the next question, sir, wish to disagree with the argument of Mr. Chairman that the CRR should be used to fund capital projects, and this will result in asset liability mismatch and create liquidity crisis in the banking system, because most bank deposits are short-term placements by customers who may need their funds anytime. Empirical research in financial crisis has proven that banking crisis, including the global financial crisis, was induced by liquidity crisis. This is directed at Mr. Chairman from Mr. Jaffet Jeff.
Fair enough.
The next question, the positive implication of current MPR on market reality in Nigeria, from Kodonu Adebayo Oluwa Yomi. I think these are the questions that we have at the moment. Thank you, Mr. Chairman. I yield the floor to you.
Which
sir.
one did you say is from Adebayo Oluwayomi?
I think he's not directed, he did not specify.
But
He
what's
didn't
the question?
specify it. What is the positive implication of the current MPR on market reality in Nigeria?
Okay.
Thank you.
Well, thank you for the questions. We know we have a panelist who is yet to speak, but I'd like the panelists who have spoken to respond to these questions. Yeah, we can do it in the order in which the questions have been asked. So you just tell us the first questions and you call upon the person that it has been directed to quickly. And where more than one question is directed to one panelist, you let them take all their questions at once. The panel is difficult. Please limit your response to about 2-3 minutes. It should be kind of you. Question 1. Let me thank all the questioners, all the people who ask questions. We want debate, we want dialogue, we want conversation. And also, we like dissenting views. We like, the academic liberty to disagree, to say, I don't agree with you. So dissent is welcome. So who is the first person that the salvo has been directed at?
Dr. Adeniran.
Okay.
And
Thank
is
you.
the question? Okay,
I think
Dr.
I still
Adeniran,
remember
remember
the
the question.
Yes,
Is it
yes,
one
yes.
question for Dr. Adeniran or more than one?
It's more than one, sir.
Oh, I only got one very well.
Oh yeah, let me read the two for you so you can do justice.
The next question, Dr. Adeniran. Sorry.
I thought you said the question was repeated as 1 and 4.
All right, it's the same question. Sorry, it's only one question.
Okay, Dr. Adeniran, the floor is yours.
Okay, thank you so much. I think thanks Olamileko for that good question. How do we achieve fiscal monetary policy that I've emphasized? Coordination and alignment. I think it's about we can't have two very important institutions just doing two things that are really counteracting one another or really at conflict with one another. I mean, we've seen that in the past whereby monetary policy institutions work on inflation and exchange rate stability, whereas all the activities and action of fiscal policy just undermine that in some extent. So, but for you to achieve that alignment, I think the first thing is to really also align on a goal. Because if you don't align on the goal, you can also achieve on that alignment. And I think for me in Nigeria, and I think from what we've discussed so far, inflation alignment is good, exchange rate stability is good, but actually the inclusive growth is actually what we want to really see. And I think we can align on that too, because in the past we've seen decline in inflation, we've seen exchange rate stability, but all of that needs to actually amount to what is crucial, the inclusive growth aspect. And I think that's why that alignment is very crucial. For me, I think that would really, really require more effort at the fiscal level. For example, in recent years, we've seen fiscal reforms like tax reforms, that the effort is about increasing government revenue. And I think, how do you really achieve alignment in that area? It's about really spending priority. What spending priority really ensure that we achieve those goals? We've spoken a lot about how can we ensure that we get more resources to real sector. But if you have this more reforms in the fiscal policies, do we really use it as a tool to really also relieve those kind of constraint or bottleneck to real sector growth? Do we ensure that even tax is not just about taxation, but also tax relief for SMEs that could also sustain them, such that even if they are not having access to interest rate, they are also not really facing burdensome taxation. So those are the kind of things we need to see and really achieve a consensus in terms of what the policy priority should be. And at the policy end, at the monetary end, at the fiscal end, we should be really speaking about really making policies that achieve that goal, rather than really each one achieving its own objectives. Thank you.
Thank you very much. Dr. Adeniran, you actually hit the bullseye that harmonization should be around goals. And I will expand it, macroeconomic policy conversation about fiscal and monetary policy is usually done within the targets and instruments framework. So unless the monetary authorities and the fiscal authorities have a common target. The ultimate goals, you may not, so you identify a target that if you achieve that target, it ensures that the goals will be achieved. So they call goals ultimate targets. And often governments select proximate targets. That you may not have any instrument that will hit the goal, but you may have a proximate target that if you achieve, to achieve your goal. And the best framework, if you look at successful macro environments like the UK, is they announce the target. They provide forward guidance, not just about the target they want to achieve, but also about the thresholds that they must meet that assures them that they're getting close to the target. And about the triggers, so if a threshold is missed, what instruments, will, be action will be triggered, change in instrument. So everybody gets the forward guidance. You can safely predict when interest rates will change, when this will change, when that will change. And the example of England is useful in that as independent as the Bank of England is, they only have instrument independence. They don't have goal independence. The Treasury has to write a letter to the Bank of England every year. They call it the remit, to tell them what goal to meet. That is consistent with the government's employment target and welfare target for Britons. That goal has tended to be 2% inflation, but they still have to write a letter every year to say that's what you mean. When they were doing quantitative easing, the Treasury has to write a letter to say, do quantitative easing of this side. So all independence of the Bank of England or the US Federal Reserve is limited to instrument independence. They have independence to fix interest rates, either raise it or cut it or hold it, but they don't have goal independence. That's one coordination mechanism. Thank you very much. That question has been, well responded to by Dr. Adeniro. Let's go to the next one.
The next person is Dr. Faith. You have 3 questions directed at you, Doctor. I'm reading them again. 1, given that monetary policy alone cannot solve structural inflation, what complementary fiscal policy or structural reforms would you like to see alongside the CBN's current policy stance? Another question directed at you is that you were spot on why monetary policy is not enough to curtail inflation. What recommendation will you give to the authority, as it is empirical from the CBN perspective, that it must deploy tightening rate to fight inflation in Nigeria? And then the last one for Dr. Faith is, you mentioned that monetary policy is not sustainable in controlling inflation. Will it be more accurate to say monetary policy alone is insufficient rather than unsustainable? Given the success of inflation targeting regimes in several economies, what empirical evidence supports your position? And what alternative policy mix will you recommend for achieving sustainable price stability? These are the 3 questions, Dr. Faith. I yield the floor to you now. Thank you.
And all the 3 questions are interrelated, and I had offered to partner with Dr. Faith.
Yes.
Do you want me to go first?
Let me just quickly give my thoughts, Prof.
Okay,
You will come
ahead.
as a superpower.
Ladies
Thank
first.
you very much. So thank you very much for your question. So I would like to frame my response around the implication of the decision on local credit and borrowing. And then I would like to also touch on some of the things my other panelists have said. So within the context of what we have seen, first, it is important to note that what the CBN has done is to tell us that we are not easing anytime soon. We are not creating relief. And then the implication is that if the MPR is 26.5 and the asymmetric corridor is about 4.5, which is 450 basis points, What it means is that banks will be borrowing from CBN at 31%. It means they cannot give credit below that rate. The implication is that the cost of credit will go up. And then looking at the credit allocation in recent times, comparing real sector credit and credit to government, within the last 1 year, credit to real sector has just increased by 3%, whereas the credit to government has increased by over 70%. So you see where the money is going to, because it is less risky to borrow to the government than to borrow to private sector. So what that means, it has implication for investment. If we cannot invest, we cannot create job. If we cannot create job, we cannot produce goods that will bring down prices, because you're borrowing at a higher cost. And you have not even factored in other structural issues. Structural issues around logistics, the cost of doing business, the fuel price, you have to generate your own electricity, you have to transport, and you also have insecurity at play. So these issues, when you look at them, it means that monetary policy alone cannot sustainably bring down inflation. That was what I said. Sustainably drive down inflation. It is not on its own sufficient. Now, what do we think we can do within this space? We have seen recent collaboration and harmonization across policy space. The fiscal hand is trying to shake hands with the monetary aspect. But I think another thing we should do is to create selective guidelines for credit allocation for specific sector that has the weight and the elastos should be able to drive what's it called, poverty down. So if we are looking at it from that perspective, from my own perspective, I think that aside just coordinating, we must create credits available. Like Prof said, you are keeping 45%, doing nothing in your COFA as CRR. It means that for every 100 Naira an individual deposits in a bank, 45 Naira is gone, and you still have a liquidity ratio of 30 Naira. It means the space for credit allocation is just 25%, which is 25 Naira of the total 100 Naira. So we cannot make significant progress if we don't deliberately expand credits to the real sector. Thank you.
Okay, thank you, Dr. Fitz. You have dabbled into the areas reserved for Dr. Ismanuddin and myself about credit, and what Japheth has said. He objected to the comment about zero interest rate CRR, but jolly well. Let me deal with the part of the question that I said I was going to partner with you on. And this matters about the effectiveness of monetary policy. Just like Dr. Adeniran had, drawn our attention to the targets and instruments framework, that unless policy makers across the different types of policies are united on a common goal and therefore a common target, it's not going to be clear how to coordinate their instrument responses. The other side that comes up from the question that has been directed at you is that monetary policy in an open economy environment is usually characterized by what they call the monetary policy trilemma, or what they call the impossible trinity. That two of the major concerns of monetary policy is not monetary at all, because the challenge in an open economic environment includes capital mobility, it includes exchange rate stability, before you now talk about the autonomy or effectiveness of monetary instruments. So out of the three items in the trilemma, only one is monetary. The two are forex. And therefore, the most important achievement of the current regime, put together the whole of government, the president's team, is the reform to the foreign exchange market, where the net reserves at $4 billion, which was grossly inadequate. And exchange rate was in a flip-flop. There's nothing monetary policy can achieve in the environment of an unstable capital flow and an unstable exchange rate. So the biggest credit to the regime is the president announcing that he was harmonizing the exchange rate, he was liberalizing the markets, and they opened the market. By the time the other regime left, only banks had access to that market. The banks even borrowed the change. And they have since liberated the space to IMTOs, to BDCs, and they liberalized it. They made it more transparent. You know, a willing buyer, willing seller, and the Central Bank governor was still acknowledging yesterday that they are not for intervention. They want, you know, willing buyer, willing seller, and market-determined exchange. Is the most important achievement of the current regime, that they've now achieved a most adequate reserve. So inadequate foreign exchange reserve has given to an adequate regime. Reserve has increased from less than 4 billion in 2023 to 40 billion net reserve basis. 40 billion, that's tenfold. Is the biggest success of this regime, because they liberalized the exchange, they liberalized inflow, and they are targeting, they say, remittances. Without that success in foreign exchange reform, monetary policy simply doesn't exist. Credit to the central bank, but credit to the central bank, but not to monetary policy committee, because monetary policy committee does not manage forex. They should be thankful to the trade and exchange department of the central bank. Credit to the CBN governor and the deputy governors, because the management of the central bank achieved that forex market reform. And we cannot talk about, you can't target inflation where exchange rate is volatile. You simply not know what you are doing. Exchange rate was volatile, there was a big premium, and the premium predicted that there was going to be devaluation. There's nothing like inflation. Inflation was accelerating every month for 18 months until they stabilized the foreign exchange market. And it decelerated, you know, more like for the next 18 months, except in March of 2025. So recognize that the monetary policy premium and the disinflation, the deceleration of inflation that we enjoyed came from stability of the exchange rate. If the exchange rate becomes unstable today, inflation will head for the skies again. So credit, you know, to that effort. And then the sectoral reform is also very important. The fact that subsidies were removed, and people are not just allocating investment based on subsidy, which can be inefficient. So investment decisions are sound, you know, they are sound, and they are you know, policies need to function in a context, you know, of a stable and efficient foreign exchange market, and stable and is growing. When the oil market is unstable, oil revenue is not stable, Nigeria is growing. The world is acknowledging it. You know, where the IMF has identified us as one of the main drivers of growth for the world. We are growing faster than the world economy, just because we got sectoral policy and forex policy right. So we are now left with harmonizing fiscal and monetary policy. I want to leave it there because I'm still going to join Professor Islanuddin. So kindly go on, take us to the next question. Thank you.
Thank you, sir.
Mr.
You
Chairman.
are almost taking my presentation.
I apologize. We will take you first in the next round of comments. But let's listen to the few questions remaining.
All right. This question goes to Dr. Islanuddin, Dr. Mohammed. According to the question, he was concerned about interest rate to be flexible to accommodate MSMEs in credit access. What ways can CBN ensure this, even as individual banks make adjustment on interest that suit their credit facilitation? That's the question.
I promise
Thank you.
to support Dr. Islanuddin on that. So, Doctor, you can go, then I'll support.
Okay. All right. Thank you very much, Dr. Sampson. Now, let's go straight. To the extent that the CBN monetary policy is anchored on its core mandate, the answer is it's very difficult to argue against raising rates to deal with issues of inflation, issues around liquidity. However, where I have most critical problem is in the CRR that the chairman has highlighted. 45% CRR, technically meaning that 45% of bank liquidity is quarantined with the central bank. And the money is attracting zero interest rate. All aimed at controlling zero interest rate. All aimed at dealing with liquidity, by extension, dealing with inflation. Now, who owns that money? At what cost have those banks generated those funds? And how are they going to mitigate those costs? They are critical issues. To think that the banks are private sector driven, they are going to take 55% and lend, even if it means above MPR plus 30%, 32% that they are lending now, some even up to 40%, to think that they will still lend, I think the answer is no. When you look at the loan book of all the banks now today, especially 2023, 2024, 2025, substantial earnings of those banks come from fixed non-interest income, especially fixed income market, which is, like I said earlier on, an easy way of making money risk-free. They have to do that because they are private sector driven and they are tight. And I think it is unfair. The policy, to my mind, is unfair. You can attack liquidity, you can attack inflation, but to quarantine 45% of banking liquidity and put in that money without doing anything with it, doing zero, attracting zero interest rate, it will not work. How can the central bank, given that challenges, now the answer is, how do they deal with the problem? Since their own focus is they want to ensure that they control inflation, they attack liquidity and so on, but they are jeopardizing growth. Clearly, how can they do something about growth? My own response is the CBN has inherited a very bad system of development financing. And because they inherited a bad thing, they threw away the baby with the bathwater. My own submission is the CBN should have a rethink about its intervention programs. Should have a rethink because the baby so somebody is bad, you cannot just throw your son away and just kill the son. You know, if it's that the son or the daughter has a problem, you should deal with the problem. And I believe they are dealing with the problem. Most of the people that have created this problem in central bank have either been sacked or either been prosecuted and so on. But to say that, no. Fiscal authorities deal with development financing. I think that is where we are having this challenge. As it is now, the banks are not lending. They are dealing with their little liquidity in fixed income market, and they're making a lot of money. People get surprised that given the weak nature of the economy in terms of supporting industry, supporting SMEs, still banks are reporting profit. The answer is go and look at their books. And the central bank can do intervention programs, secured intervention programs through development finance institutions and so on. But to just close their eyes and say, no, the fiscal authorities should deal with that problem. I don't think we are solving one problem, but we are deeply, deeply creating another problem. The central bank is doing very well in terms of managing exchange rate. We are having very good liquidity now. We have stable exchange rate. Inflation is being tamed. Interest rate is managed based on the monetary policy system, but there is challenge with growth. And if there is no growth, there is no productivity. If there is no growth, there are no jobs. And if there are no jobs, there will be no impact. And that is why even the World Bank are challenging our economic trajectory. Our macroeconomic variables are excellent. Everything is going well, but it has not trickled down. And it cannot trickle down if there is no access to credit. So the only way central bank can support that to mitigate the negative side of their policy in terms of growth is to come back with the intervention program, well articulated, well secured, devoid of any challenge of having the abuse that truly the present central bank management inherited from the previous central bank management. Thank you, Chairman.
Okay, Dr. Isdaludin, you tend to spend a lot of time, but I didn't I didn't interrupt you because we are making very, very good points. Let me add to what you have said. Please don't let the central bank do intervention. There's no reason why the Central Bank of Nigeria should do the kind of intervention that we saw under the Emefiele regime. The interventions were rogue interventions. You allowed a governor of the central bank who was buying nomination form to be president while he was governor of the central bank to do interventions. It was all politically tainted. Was it the anchor borrowers program or which? There are development finance institutions. You were chief economist of the Bank of Industry. Let the Bank of Industry do intervention. The government has recapitalized the Bank of Agriculture with 1.5 trillion. Let the Bank of Agriculture do intervention. Let the central bank do monetary policy. Let them do foreign exchange policy. They should not do intervention. They are not intermediaries. They don't have the capacity. Anything that they try to do directly will be corrupted. So let them encourage development finance institutions to do the jobs that they are created for. That's number one. Number two, MSME credit is a developmental financial issue. And the health of large corporations is the health of MSMEs. All large corporations, without exception, have MSMEs either as their suppliers or as their distributors. And I know the extent to which those large corporations, including multinationals, go to advance credit to the MSMEs who are their suppliers, whether it's the telecom firms or it's the beverage companies or it's the cement firms or any big company can't survive without millions of MSMEs who are there, either their suppliers or their distributors, who extend them trade credit. And a lot of MSME cooperatives also have access to rotational credit within their cooperatives. So we can't say that bank interest rates is set for large corporations. And we should let, just like the exchange rate market is willing buyer, willing seller, we should let the bank, give money to MTN. MTN will give trade credit to millions of MSMEs. Coca-Cola will give trade credit to millions of MSMEs. It's trade credits. They don't pay any interest. So I just want to leave that there. And I want to extend it to the conversation, the point that Japheth raised. My point is that central bank should be more sensitive to the need of economic growth in the country. That sitting on 45% of deposits at zero interest rate is unnecessary at any point in time. Zero interest rate, emphasis on zero interest rate. You can sit on 90% of their deposits, but pay interest rates. You are holding 28 trillion of federal government securities. The federal government pays interest rate to you. So when you sit on any bank's money without interest rate, money that they attracted, even if this is a demand deposit, they spend money to open that branch. They spend money to start that branch, and then you sit on it. It's reckless. And I don't want to use any more words than that. So let's make a case for, if you must sit on those CRR balances, pay interest. But why must you sit on the CRR balances? Why don't you go and take the 31 trillion pension money and sit on it as well? So the way you avoid inflation is to regulate the portfolio of the pension fund administrators or the pension fund custodians. You can't obstruct them. You can't say don't invest the money. You can give them, portfolio allotment, regulatory portfolio allotment, and make sure that they don't put the money in items that will be inflationary. Do the same with banks. So problem that you need to set with bank supervision. Problem that you need to set with bank regulation. Don't make it a monetary policy. I don't know any other country that uses CRR as a monetary policy instrument. It's not a monetary policy instrument. It's a prudential policy instrument. Most countries in the world now set CRR at 0. But on a prudential basis, they say that if you cannot manage your liquidity, as long as your liquidity is out of line, you pay that 3% or 10%. And once you get your liquidity back in line, you pay 0 CRR. You observe 0 CRR. And it's not for all the banks. It's only for the banks that have excess liquidity. So that's my point, Japheth, that 28 trillion that is in CRR deposit, either central bank should pay interest rates, or central bank should do what the pension commission is doing with pension fund administrator. You can't put any percentage in inflationary components. You should put this in this. You regulate, not that you seize and sit upon it when Nigeria needs this money, to make progress. Thank you. Next question.
All right. The next set of questions. These questions go to Professor Comfort.
No. Of them. Is it? How many questions do we have left?
We have like 5 to go.
Why? All the ones they have answered. Don't add any new questions. So it's the ones that you read to us.
All right. The ones I read remaining 4.
Yeah, quickly. How many people responding?
All right.
How many people responding?
To the chairman and then Professor Comfort.
I have answered my own. I hope Japheth is satisfied.
Not the ones directed at you. All right. There are some questions that are specifically directed at you.
Okay, take Professor Comfort's one, and then let me know the one directed at you.
All right, sir. Professor Comfort, the first one. Given that food inflation remains the largest contributor to headline inflation and is largely driven by supply-side factors, how effective can maintaining a tight monetary policy be in bringing food prices down? What complementary fiscal or structural measures do you believe are most urgent at the moment? Then the second question for Professor Comfort. All right, I think that was the only one directed at Professor Comfort. Sorry.
Okay, Prof.
Thank you. So 2 were read before, but the first one, when we are talking about what we can do, particularly to bring down food prices, as much as possible, I said it in that short introduction that we need to work on agriculture. In Nigeria, as it is, the farming region, we need more security things there. Because without security, people are not willing to go to farm. And if they don't go and they don't produce, then food prices will keep on the increase. Also, we have to look at logistics and transport, as I've said, that if those areas could be worked with as much as possible, I want to believe that food prices will be curtailed. The second question read earlier was on the harmonization, that what are the challenges in harmonizing particularly fiscal and monetary policy in Nigeria? Well, policy harmonization in Nigeria aligning laws, regulations, and the policy across federal, state, and local government faces several challenges over time because of the fiscal federalism that we are running. And this stem out of so many things. Our federal structure and autonomy, state, federal, local government, and the others, they constitute a kind of challenge. Then we have weak institutional coordination. Government agency at times, they work in silos rather than collaboratively. And the political interests and power struggles, they are part of those challenges that we face to harmonize policy, particularly between fiscal and monetary, legal and constitutional constraints, as well as capacity, because majority of what is needed to be done, we have not really developed our skilled personnel that can do it. Diverse socioeconomic and cultural context, among others, plus corruption. Thank you. That's what I have to say.
Dr. Simon.
Thank you, Prof. Yes, sir.
Read that question again. The one that Prof.
For, all right. The first one is, given that food inflation remains the largest contributor to headline inflation and is largely driven by supply side factors, how effective can maintaining a tight monetary policy be in bringing food prices down? What complementary fiscal or structural measures do you believe are most urgent at the moment?
Okay. You said it's the first. I thought you said it's only one for her.
All right, I think she got the second one. I couldn't see it immediately, so okay. But she got it initially when I read them, so she answered both.
That's okay. That's okay. So, point. Recent inflation has shown, particularly with the crisis in the Middle East since March, that energy inflation is the largest accelerator, which fits into transport cost. And of course, food has to be distributed. So food is really not the most inflationary component, it's the fuel price. And we know how much pump prices have surged. Of course, that affects transportation and that affects food through the supply, input transportation and output distribution. And you've seen what even the new Prime Minister in England is doing, you know, to relieve the populace of energy costs, reducing the VAT on electricity bill. You know, they've done things about energy. Our government has done something about aviation fuel, but we didn't do anything about PMS, which we would have done. Not to touch the market price, but to see how relief can be provided to the vulnerable. Many states are providing mass transit, you know, at subsidized rates, you know, CNG buses. Some states are doing thousands of taxis. In Lagos, 7,000 taxis, you know, in Enugu, in Zamfara, and the rest. All in an effort to reduce energy cost or transportation cost or food distribution cost. Let's just say, you know, that everything is not going to be monetary policy. The most damaging component of monetary policy has been passed through from exchange rates. Our government has brought that under control. It's because of the stability of the exchange rate since December that you've seen that inflation itself has been 15 in December, it's still 15 point something today. You know, so, but the shocks from energy, you can't wish away. Government has to come out and subsidize people's access. Let the market price, you know, ration. We can't comment the fact that removal of subsidy leads to more efficient investment allocation. Yeah, and then say you should touch the price. Don't touch the price, but help the people who cannot afford access to gain access. Thank you. Let's take, is there a final question to who, please?
To the chairman, sir.
Okay, read it.
All right. This question is for Dr. Ayo Chariba, the chair, sir. The CBN said the recent moderation of the food inflation, I'm reading it verbatim, I know this is not correct. Food inflation at 15.91% is one key consideration, as well as the ongoing Middle East crisis. Informed they are retaining 26.5. Kindly share your thoughts on this.
I agree with the CBN for the need to be cautious. Any reservation I have about monetary policy, I have had it for 2 years. And it's about the CRR and the MPR, that the MPR is disconnected from the market. The CRR is obstructive. You can supervise banks with their portfolio allocation. You don't have to render it idle at zero interest rate. But the fact that there's need for caution right now, I agree with the central bank. I commend them what they have done with the foreign exchange market. I commend them the improved liquidity in foreign reserves. And I commend them, with their cautious approach to monetary policy. So what they've told us is that there's peace and tranquility and resilience at home. They spoke positively about economic conditions at home, about the gains of reform. But they said the main problem in the outlook is the escalation of hostilities in the Middle East. We know what it has done to fuel prices, and we know what it is doing. And that we can't keep that fire on our roof and begin to play around with monetary policy variables. So let's sit down and watch so that they can tackle with any challenges coming from that. And I agree with them. I have no reservation about it whatsoever. Inflation at 15.1%. Hey, we were 35% in November of 2024. And we should be grateful to God that they found a path to bring it down from 35% to 15.91. And we got to 15 since December. We've allowed it to creep up to by 0.91. Yes, whatever happened in the Middle East is out of our control. Every country in the world is paying for it. And so we shouldn't blame policy on that. Let's hope that hostilities will come to an end and we can go back to the trajectory that brought our inflation down to 15%. Will be what I will say. But we are grateful that the exchange rate remains stable. We are grateful that forex liquidity keeps growing. We are happy that the stock market liquidity keeps surging. So the biggest companies have access to, large amounts of liquidity in the stock market, and that will rub off on the small companies who will be their suppliers, who will be their distributors. Thank you very much. Now, we'll take the next round. How much time do you have left?
3 minutes.
3 minutes.
Yes, sir.
Yeah, technically, Chairman.
Let's give
we have 3 minutes because our goal was to conclude the session by 1 o'clock. But Chairman, you can exercise some discretion when you see some critical issues that need to be properly tied up, especially as we have another panelist that is waiting. Please exercise your discretion. I think the conversation is very exciting. So
this has been fruitful conversation. Let's listen to Prof, the new panelist. Prof, you had that we have 3 minutes left, and that was a minute ago. Can you please give us your views in no more than 5 minutes? After that, we can decide if it's time to close it. Every panelist has had 2 opportunities to speak. Members of the audience have had opportunity to ask questions. So I can just say, you speak and then we'll see, we don't want people to start leaving. So Prof, the floor is yours. Apologies that we kept you up till now.
Thank you, moderator. We are grateful. I was to speak on foreign exchange rates, capital inflows, and the asymmetric corridors. But of course, I want to thank God for the chairman who has touched on different aspects of the foreign exchange rate as it affects inflation, as it affects investors' confidence, as it affects capital flows, and all of that. So we also know that foreign exchange rates is driven by demand and supply. Demand for import of goods and services, especially in Nigeria, that is import dependent. And of course, export also play a role. Of course, our export basically is oil and some little of solid minerals. The other aspect that also drives the foreign exchange market is the interest rate differentials, which affect capital, it affects inflation, it affects trade balance, it affects investors' confidence, and recently also is used as a political tool because many politicians are using it as an instrument of whether the government is successful or it is not successful. And we know from our theoretical knowledge that when the demand for foreign exchange is greater than supply, the currency will depreciate. And that is one of the biggest problems of Nigeria. And that has led to government or the central bank targeting and monitoring the upper and the lower bound associated with the with foreign exchange. So the central bank has worked so far within this little period, the last 1 year, it has been able to regulate or control the level of volatility in the exchange rate, and thereby building up the foreign exchange in Nigeria, so that when there is excessive fluctuation or depreciation in the exchange rate, it intervenes to bring about stability. When that stability is achieved, it helps companies, it helps investors, it also helps reduce pressure on the inflationary rate in Nigeria. So we also need to understand that the foreign exchange supply affects the local currency, and that is where inflation, it affects the rate of inflation also in Nigeria. But we also thank the central bank for its ability to intervene, and this intervention has led to increase in reserve. So that is a good achievement for the central bank. Also, because inflation raises a big challenge for us to import, the central bank has also been able to work on the aspect of continuous import of goods and services in terms of ensuring that the foreign exchange is made available, deregulation of the market, such that all participants also are able to buy the currency at a common rate. Now, the other aspect is the asymmetric corridor. Now, the asymmetric corridor, we also know that is an aspect which the central bank watches closely, because it knows that if there is excessive depreciation of the currency, we will experience capital flight. And everybody knows that that is a big challenge for any economy. If there is capital flight, it also spikes inflation. It also increases our debt burden. And that is an aspect that the central bank has always worked on to ensure that the asymmetric corridor bound is reduced. Okay, I didn't get that. Hello? Hello?
Somebody needs to switch off his or her mic. It's not for you. Somebody's mic was on and the noise came.
Okay. Okay. So the central
Prof, please
bank
round up in 1 minute, please.
Tightening. Okay, the central bank has to keep tightening the asymmetric corridor in order to reduce the ability of the foreign exchange market to depreciate continuously. And that has helped to stabilize our economy. So by and large, the central bank is working in the right direction to ensure that there is stability, there is capital inflow, and to reduce the gap that is excessively being experienced in the past in terms of the asymmetric corridor. Thank you, sir.
Thank you very much. It's on this note that I want to observe that we didn't start at 11, but I didn't ask us to do a time check when we started. We should have been aiming for 2 full hours, but it's okay. From the quality of the contributions of the panelists, I think this has gone far enough, and it will just be my role now to say thank you very much to all the panelists for their very, very fruitful contributions. They've had 2 bites at the cherry, but because of time, we won't be able to allow the 3rd bite of the cherry. And we won't even be able to allow Prof to take any questions. We want to draw the curtain on it now, and that even makes it nicer. So next time when Dr. Amanze calls us, we will respond because we know he's likely to keep to time. And we shouldn't exhaust all the issues today so that there are some issues for us to explore the next time we come around. So panelists, thank you so much for your interventions. The questioners, thank you so much for your piercing questions, for, taking, the liberty to dissent in cases where you had dissented. And to Dr. Amanze, thank you for making this happen. Dr. Simon, thank you for helping us to summarize the questions. So it's on this note that I will declare the panel session closed and will now hand over to Dr. Amanze to make his closing remarks. Thank you very much, everyone.
Thank you so much, Mr. Chairman. I want to appreciate you deeply for the privilege of having you on this program. I also want to appreciate the panelists. Let me mention clearly that none of these key personalities on this platform are people you can easily pick and bring to this kind of forum. There are people who are in high demand. There are people who are very, very engaged because they are some of Nigeria's best experts, especially in the area of policy and economics. So I want to appreciate you deeply. And to the audience, I appreciate you for your patience. I know that when this program, we were communicating it, we had about 250 people as at yesterday that registered. But quite a couple of you have decided to demonstrate that you registered to be able to imbibe the potential knowledge from this very advanced expert. And I want to appreciate you deeply. On a final note, I want to say that Macrostrat will be organizing similar sessions, policy sessions like this, every month up to the end of this year. And I will crave the indulgence of all of us who are here to be on the lookout for our communication materials on our our policy event calendar. We will also be sending you emails about such virtual policy event. And what you have put together here will not remain just on this virtual platform. The recommendations, they are of the highest quality anywhere in the world. And we are going to ensure that we bundle, we aggregate, and we put all of them into a policy brief and a much more expanded policy conversation book for the authorities and even those who are just learning about policy and the economy to have the privilege of assessing. The package, the general package will be put on our website, while the policy brief and other accompanying materials will be sent to the central bank, to the financial authorities, mainly the Ministry of Finance. So on that note, I want to appreciate all of you very deeply. And we pray that if you have such a session, we will also be ready to join you whenever you need us. Thank you once again, and may God bless us all. Thank you. Bye.
Thanks. Bye.
Bye, Chair. Thanks so much, everyone. Thanks. Bye.
Amen.
Thank you. Thank you.
Thank you. Bye-bye.
Thank you, Chair.
Bye.
Thank you,
Prof.
Director.
Thank you. Thank you,
Thank
Prof.
you.
Bye.
I appreciate it. Goodbye, sir.
Man, well done, Prof. You really took the floor by storm. I hope the central bank governor were here to listen to what you guys were saying. There are very few key points that they will argue with. Thank you, Prof. I got your mail from your staff, and I said that after this event I will.
Oh, okay, yes, sir. Yes, sir. Yes, sir. Thanks so much. And thanks for the webinar. The time was too short to respond to those issues, but I think it's quite timing and what you like you say, what you can do is to now package a communique and if possible brief that people can also read online and have more informed positions on all those key issues. Like somebody said, we can clap with one hand. We need both hands to clap. The fiscal policy, the policy. So that's what these are issues. And there are many emerging issues. Yeah, even there was the retreat I was part of on Monday by the House Committee on Finance and also the Revenue Mobilization Physical Allocation Commission. All of these are also issues that so we need stronger handshake between the fiscal policy domain and the motor policy domain, which is quite important. I know there was no
so much.
This, but let's package the report, communicate possible, and let the wider audience have input. Thanks so much for you. The opportunity, sir.
Thank you so much. Thank you so much.
Thank you, everyone. Bye.
So I will respond formally, and then the various angles we'll be looking at the various areas that we can support. So
yeah,
I'm sure it will be very okay.
Okay. Thank you, sir.
Thank you so much. Thank you so much. Thank Madam. I apologize for my disturbing her.
No, all is well. Thank you so much, sir. Okay, bye-bye for now.
Okay. Thank you so much. Bye. Bye. Bye to everyone.